Hello, welcome to FactorLab. I'm Shekhar and I have Deepak with me. Today we are doing an important session, employee-related stock compensation. We got a lot of questions from our clients regarding ESOPs, RSUs and stock grants. And many people come us asking, is it the right time to divest? Should we even divest it or should we accumulate? So we felt it is the right time, good opportunity for us to throw some light and overview of how do you approach this particular problem statement. And to discuss this, we have a very important guest with us, Mr. Harsha Kunduri. Harsha was heading Microsoft Asia as General Manager, and he has more than a decade of experience working with Microsoft. And we felt that he's the right person to guide us on this topic. And by the way, he's also a prolific investor by himself, having invested across US and Indian markets. So we felt it is a great discussion. And if you see the need for this, of late there have been a lot of IPOs in India, Paytms, Swiggy, Zomatos, Mama, and also even in the US space, where the magnificent seven companies like Nvidia, Meta, or Google, they have grown rapidly because of the AI boom. And as a consequence of this, we've seen a lot of people, or a lot of folks who have accumulated enormous amount of wealth because of the ESOPs or the grants that they have according. Now, for tens of such cases where we see people having accumulated enormous amount of wealth, you also see lakhs of people who are still holding ESOPs, but not knowing whether it is the right decision for them to continue to hold these ESOPs or not. Just within the very few few people of the employees who were lucky. So we wanted to do a deep session on this to understand. Asha, based on your experience, what do you think? What do you think about an employee? What should he do in general with regards to ESOPs? Should they continue to hold them, or is it something that they need to divest altogether?
Yeah, no, it's a great question. I think, as you rightly pointed out, at the way the market is, it's a very pertinent topic for us to have a conversation around. The way I view any employee-related stock compensation is it should be part of your entire holistic financial plan, right? A lot of times I see individuals that I interact with are very ignorant of or sort of turn a blind eye towards how much of their net worth is really squared away into these employee-related stock compensation. I truly believe it's a huge part of what everyone should be paying attention to. I think the standard risks that apply to a well-balanced portfolio also apply to this, right? So there's concentration risk in the sense that you can have a significant amount of your net worth indexed on just one or two stocks. As an example, there was a point in time when I was early in my career at Microsoft where 90% of my net worth was riding on the Microsoft stock. Now, over long periods of time, especially after I started having kids, right, I couldn't afford to take that single company stock risk. So now I have a metric of 25%. The second area where people tend to not pay a lot of attention to is also as they grow within the company, a lot of their compensation sort of indexes towards sort of the equity from that company. So there's a lot of future compensation also riding on that. So that needs to be a factor in your holistic plan. The third thing is I think, like you said in the preamble, which is, we've seen an extremely good bull market for the tech companies, where if you look at a lot of, my friends, a lot of them largely work for, he worked for the cloud SaaS companies for a bit. Now the hyperscalers and the chip companies of the world. Think about from their perspective, they've seen an extremely good run, but there's also the risk of recency bias, right? In the sense that what has happened is there's no guarantee will happen in the future. So I think it's a question that everybody should be asking about their own portfolios as to how much they're exposed to that particular company in general.
So what I'm seeing this as a psychological problem or a behavioral problem more than a math problem, if I can say that. So, for example, one of my friends is working with a logistics company. He believes that logistics is going to be the next boom. right? And another client of ours is in an EV space, and he feels that EV or green energy is going to be the next tool. So they continue picking those kind of stocks or keeping ESOPs or heavily invested in, or keeping most of their weight of their investments in those kind of ESOPs. So what are these psychological traps that you're seeing? Like, how did you able to come out of it? Why? I'm sure you must have faced a similar feeling when you were working with Microsoft.
That's a great point, and I think that you're spot on. Like even when I talk about this topic with a lot of my friends, there's always this familiarity bias. So traditional investing, the kind of biases that you see is what sort of translate to when people deal with their own employer-related stock compensation as well. So in that particular example, the way I thought about it, and I think the way people should think about it, is in a well-balanced portfolio. Stock risk is extremely bad. Like after a certain point, I would say sectoral concentration is also can be pretty harmful. I think one of the things that people tend to discount is people have this macro view of how things will pan out. Right? As an example, airlines as an industry, and nobody, including the best of the investors, have not made money on airlines as an industry. So when you pick the sectorial bets, you although you feel like you have a lot of insider information because how you see the sector panning out, it may not eventually be the case. So I would go back and sort of think about any gains or any proceeds that I get from sort of liquidating or keeping that under that 25% threshold that I talked about. I look at it as pure cash. Right? See, if I had $100,000 or 2 lakh rupees that I can invest today, how would I use that money to sort of allocate to achieve a well-balanced portfolio? I don't typically look at which sectors are going to be the outperforming sectors, right? If I have a basket of ETFs or mutual funds that I feel like are a well-balanced portfolio, that's where that capital goes to. So I think those are, I think familiarity bias is a huge thing in this space, and also from that familiarity biases you have this sort of conviction that you form based on very macro view, which doesn't necessarily translate to how that particular industry would perform over long periods of time.
Have you seen any examples? So I think most of us would see these glorious examples of people became, like, let's take Nvidia as an example, right? So most of them became millionaires after the rally it went through, right? So people see these examples and assume that if I continue to hold on this stock for a long time or these ESOPs for a long time, I might be one of them, right? So probably they're not seeing the other side of the coin. So have you seen any painful examples to validate this?
Yeah, I mean, for every Nvidia, as an example, like in my graduating class, both across MBA and my undergrad, of the 1,500 people that went to class with me, less than 10 of them work for Nvidia. For every Nvidia employee, I know 100x the number of people that are not working at Nvidia. I mean, you draw a parallel to someone like one of my close cousins has Target stock, right? So she didn't necessarily do anything with that Target stock for a very long time. Target corrected and she lost about 40-45% of what she thought was her net worth. Novo Nordisk is a great example, right? So when the COVID vaccines were announced, Novo Nordisk was on a rally. A few people that I know that have sort of held on to shares of those particular pharma companies that they were working for, and today turn out to be their net worth got halved, right? So I think, yeah, I mean, people give these examples of holding on to these rallied stock. It's a great way of saying, hey, somebody bought X amount of Bitcoin, in way back, even before Bitcoin was invented, and they kept holding on to it, right? There's always counterexamples, right? When I think about, I don't want to be part of any idiosyncratic risk, right? After a certain point in my life, especially after I cross 35, I want to compound wealth in a very well diversified manner over long periods of time. And for me, when I take any idiosyncratic risk, it sets me back by years, which I just don't have that time luxury anymore as I get closer to 40 and sort of look at my own investment portfolio. So the first thing that I try to eliminate is even in my own portfolio, 20% is the maximum concentrated bet that I would take on a particular company, because I am a human being. I make mistakes. Even when I think about my own companies or like companies that I work for, I could be making the same mistake with the company that I'm working for. Although I have this feeling that I have this insider view because XYZ product is launching, it may take market. You actually don't know what is really going on in the marketplace. There may be 10 other companies that are working on the same product at the same time. I'll close it off with one example, right? I know I don't want to name the company, but when COVID happened, one of my friends was working for one of these pharma companies. He thought he had not just an insider view, a very close view on what was going to be the first drug to market. And it so happened that they were late by 6 to 8 weeks, and they got outdone by a competitor, and their stock did not get. He actually liquidated a lot of his S&P 500 holdings and bought the stock because he thought that he had that insider information, which turned out to be quite opposite, right? So I think people have to recognize the limits of the knowability and then take the bet. From that standpoint, if I look at my own portfolio, I don't take any bets that are idiosyncratic from that standpoint.
Now, you mentioned that you don't have more than 25% of your holdings in ESOPs. So you have built that framework. Let's say if someone approaches us, and it is a general question to Deepak and Harsha also. Let's say if someone approaches us saying that I am holding most of my wealth, at least 75% of my wealth in ESOPs, how would you plan and tell them what is the next 3 steps that you would do to mitigate it, let's say, to 25% or 30%?
Yeah, and I'd love to hear from Deepak on this, given like you're probably meeting a lot more people than the informal conversations I tend to have.
Yeah, so quite a few of my network, our clients as well, I myself have worked in Amazon before taking this up full time, right? So I ensure that my net worth as well, is not heavily biased with one particular stock. So I think one question that I typically get is, what is the right time to do this, right? And there's not really, no one can really predict this, and anyone who tries to predict the markets will only get that wrong. So one way we think about this is, just like, an SIP, you think of this like an SWP strategy where you keep withdrawing a certain portion of the money so that you get that portion of the ESOPs to a meaningful limit and not, over stock your entire net worth with a particular set of ESOPs, right? So, follow an SWP and then, try to do an immediate SIP so that you are essentially ensuring a diversified portfolio.
Right. It's a great response. I think there's a couple of things that I'd like to make sure sort of I draw parallel to what you're saying, right? So I'm going through one such phase right now in my own reallocation. I call it like systematic reallocation plan. Every week on Monday afternoon, I have a certain formula I've written down for the next 3 months. I'm going to sell a certain percentage to rebalance back into the market. In that, given my prior experiences, I'm trying to avoid 2 sort of biases. One bias is timing the market, right? And I'm not sitting on cash. I'm sort of, every week that happens, I reallocate that immediately to whatever asset class I've chosen as where I would want to invest. That's one thing that what I do. The second thing is I don't have sunk cost fallacy. What that means is I'm not waiting for just because, I got the last stock vest at, $100 and today the stock is trading at $80. I'm not waiting for the stock to reprice to $101 where, I'm trying to rebalance my portfolio. I think I have enough of future equity coming from that company that I will participate in that upside if that happens. What I'm essentially trying to do is I'm protecting the downside if it goes below a certain threshold. So I'm trying to avoid both the timing of the market and the sunk cost fallacy through this systematic reallocation plan.
Actually, I went through a similar problem when I was, given Amazon ESOPs. So I tried to sell the stock at when it is when it is at an all-time high. So I keep waiting for the stock to go to an all-time high to sell the stock, and I thought I make money by using this strategy. But what happened essentially is, I stayed invested in those ESOPs for a longer time, and instead I would have invested in a S&P 500. I would have probably made same amount of money with much lesser risk or much lesser volatility.
Yeah, I mean, there are many such examples of private stocks that people thought the CEO would eventually announce the IPO and they would get liquidity to their, and people have not done secondary market transactions, etc., because people were betting their future on someone else's decision. And there's a lot of dynamics that is going on that you're not party to the boardroom conversations where the timing of the market is right or not. Meanwhile, your life, your kids, everybody is sort of growing up around you, sort of your financial plan is your financial plan. I think this association also of identity to the company's stock is also something that I tend to see that behavior a lot. In my opinion, the very fact that you are working for that employer independent of whether you hold the stock or not is a vote of confidence that is where you would want to invest your time and sort of your human capital, if you will. You don't need to reaffirm your position to the company by over-indexing your future, right? That's not the intent of the company. The very fact that they have future grants that they have. Now, my own wife, like she got allocated PayPal stock at probably the highest point that PayPal was at, right? So, and I kind of go through periods where PayPal is actually at an all-time low if we think about the last 7 or 8 years, right? So these are patterns that you see. Hadn't she divested some of it, it would have turned into something that would sort of put a dent in her own retirement plan. So, by the way, any of this is not stock or investment advice. It's just like examples of people, what they've done, and specific securities that helps land these examples well.
Got it. Cool. So I'll try to wrap this up with the key takeaways from this conversation. The first thing is that having ESOPs more than 25% of your total net worth you should reconsider that amount. I think 25% is a good benchmark. And how do you recalibrate it? Let's say if you're exceeding 25% of your net worth in ESOPs, then you can use the strategies that Harsha and Deepak have mentioned, that is to do a systematic reallocation plan, that is slowly divest from the existing ESOPs into other asset classes of your choice. Now, what are those asset classes of your choice? I'd like to throw some light on that. You could choose an asset class which is truly uncorrelated and that makes your overall portfolio well diversified. Let's say if you hold a tech stock, then maybe investing in an index fund or maybe a good factor fund would be an example of allocating in a fashion which is uncorrelated. Let's say if you have an ESOPs in a fund which is listed abroad, let's say in US or the NASDAQ, then maybe investing in India fund would automatically be an uncorrelated asset class. So that way you could divest. So these are the 3 key takeaways from this discussion. Thanks a lot, Harsha. Thanks, Deepak. Have a great day, guys, and see you next week. Bye.